All right, let's jump right in. Today, we are talking about a pretty advanced professional level strategy called delta hedging. What is it? Well, think of it like a price shield you can build around your portfolio when the market suddenly decides to go haywire. So, if you've ever wanted to know how to really defend your trades when things get volatile, you are absolutely in the right place.
So here's our game plan for today. We're going to start by figuring out what the biggest threat to any investor really is. Then we'll talk about this idea of neutrality as our main line of defense. After that, we get our hands dirty. We'll look at how to calculate your risk, step by step how to build a hedge, figure out the exact right time to put it on, and finally, what to do once that shield is up.
Okay, so first up, the investor's biggest fear. And, it doesn't matter if you're just starting out or if you've been doing this for decades. Every single one of us faces this one giant fear. And that's just how unpredictable the market can be. It's the one thing that can just wreck even the best laid plans.
So I want you to really think about this for a second. What is that one single threat, that one wild card that can do the most damage to your portfolio, the thing that probably keeps you up at night? Hint, it's not volatility and it's not time decay, even though those are big deals. Nope, it's something way more direct.
There's this fantastic analogy that really hits this home. Imagine you're a turkey on a farm. Every single day, you get fed, you're protected, life is good. And with each passing day, you become more and more sure that these farmers are the nicest folks on the planet. But all that good data, all that confidence, it's all leading up to one very bad day that your past experience gives you zero warning about. And that, right there, is the perfect metaphor for what we're talking about in investing. That unexpected event is a sudden, sharp price move. We call this directional risk. And its name is delta. Think about it. A market can be super calm for weeks, even months, and we get comfortable, right? We feel safe. And then bam, something happens and the price just tanks or skyrockets against our position. That risk, that exposure to the direction of the market, that's your delta.
And listen, the pros don't mess around when they talk about delta. They call it the big wild card. They say it's the one that you will fear. Seriously, it's not just some other number on your screen. For anyone trading options, delta is the real boogeyman. It's the thing that can take a trade that's looking great and turn it into a massive loser, like in the blink of an eye. Okay, so we've identified the villain of our story, right? It's delta, that sudden, nasty price move against us. So what do we do? How do we fight back? Well, the answer isn't trying to predict the future, because good luck with that. The answer is to build a defense, and that defense is all wrapped up in this idea of neutrality. This is where delta hedging comes in. I want you to think of it as a purely defensive move. It's your price shield. Your trade is in trouble, the stock is moving against you, and you pull up this shield. The whole point is to protect your position from taking any more damage from those price swings. It buys you time, it lets you breathe and think clearly without just hemorrhaging more money. And this chart here just lays it out perfectly. Look at the left. A normal, directional portfolio. It's totally exposed. The market goes your way, you make money. It goes against you, you lose money. Simple as that. But now look at the right, the delta neutral portfolio. It's shielded. For small little up and down wiggles in the price, the value of your position basically doesn't change. You've just taken that big wild card direction and put it on the sidelines, at least for a little while.
Now listen up, because this is a super important point. A lot of people hear hedging and think it means you magically make the trade a break even. That's not the goal. The goal is pure damage control. You're already in a losing position and you're hitting the emergency brake to stop the bleeding. It's about reducing further loss. It's risk management, not risk elimination.
All right, so if we're going to build this shield, we need to know exactly how big of a shield we need, right? And that means we got to get a little technical and really understand our delta exposure. So let's dive deep into the mechanics of this thing. Okay, so what is delta exactly? In the simplest terms, it just measures how much an options price is going to move when the stock it's based on moves by $1. So if you have an option with a delta of 0.50 or 50, that means for every $1 the stock goes up, your options price should go up by about 50 cents. It's literally a measurement of your directional risk. And of course, the direction of that delta matters. Calls, which are a bet the stock is going up, they have a positive delta. It makes sense, right? Puts, a bet the stock is going down, have a negative delta. And just to complete the picture, a share of stock has a delta of exactly +1. Why? Because for every dollar the stock goes up, well, it goes up $1. And if you're short the stock, you guessed it, its delta is -1. Okay, theory's great, but let's look at a real example. let's say your portfolio has just two option positions in it. First, your long one call contract, and its delta is positive 0.52. Now remember, one options contract controls 100 shares, so we multiply that delta by 100. That gives us a position delta of plus 52. Okay, simple enough. But let's say you also sold a different call contract and its delta is 0.30. Since you sold it, you're short. Its effect is the opposite. So we take that delta and flip the sign, making our position delta for that one negative 30.
So the big question is, what's your total exposure? Easy. We just add them up. You've got plus 52 from your long call and minus 30 from your short call. That gives you a grand total, a net delta of plus 22. Now that number, plus 22, is everything. That is your directional risk right now. It means that for every $1 the stock goes up, your whole position should make about 22 bucks. And of course, if it drops $1, you're going to lose 22 bucks.
Okay, so we did the math. We know our net delta. We know our exact risk. What's next? Well, we got to neutralize it. So now let's get into the step-by-step, the real how-to of actually putting on the hedge. And look, it's actually a pretty straightforward 3-step recipe. Step 1, calculate your net delta. We just did that. That's the number you're targeting. Step 2, choose your tool. The easiest, most direct way to do this is just to use the stock itself. And step 3, you take an equal and opposite position to cancel out your net delta. Simple. So let's apply this to our example. Remember our net delta? It was plus 22. So to get that down to 0, what do we need? We need a position with a delta of minus 22. Well, we know that shorting one share of stock gives us a delta of minus 1. So we just short 22 shares of the stock. That gives our hedge a delta of negative 22. Add that to our original plus 22, and what do you get? 0. Boom. You are now delta neutral. The price shield is officially up.
Okay, so you know how to do it, but that's only half the battle. Knowing when to do it is arguably even more important. I mean, you raise that shield too early, you could kill off all your potential profits. But if you wait too long, well, it's too late. The secret here is having a set of rules you decide on before you're in the heat of the moment. And this is great. The source material lays out a perfect checklist of triggers. These are your signals. For example, maybe you decide to hedge the moment the stock breaks through a key support or resistance level that you identified. Or maybe your triggers when the stock price actually hits the strike price of an option you sold. Or maybe it's when the trade hits its break-even point. There's even a more advanced one called the theta switch point, which is when time decay flips from being your friend to your enemy. The key thing here is that all of these are objective. They're based on data, not on fear or greed.
All right, shield is up. You're delta neutral. You can relax, right? Not so fast. The job is not done. This isn't a set it and forget it kind of thing. Hedging is an active, dynamic process. You got to manage it.
Think about it. The stock price doesn't just stop moving. Time keeps ticking by. And as those things happen, your position's delta is going to drift away from 0. It's going to start creeping up or down again. And that means you have to keep an eye on it and make adjustments to keep that shield working. So what does that management look like? Well, it's really two main things. First, you have to rebalance. Let's say your delta drifts to, I don't know, plus 5. Well, you'd have to short another 5 shares of stock to get it back to 0. This could be something you check on every day. But second, and this is just as important, you need to know when to take the shield down. If the stock turns around and your original trade starts looking good again, you can remove the hedge and let your profits run. The shield is a temporary defense, not a permanent prison.
So let's wrap this up. By learning how to get delta neutral, you have learned how to take the single biggest threat to your portfolio, direction, and take it completely off the table. You've tamed the big wild card. But, and this is the really cool part, in the world of options, delta is just one of the big forces at play. We call them the Greeks. So even when your delta is 0, you still have time decay, known as theta, working on your position. You still have changes in volatility, called vega, messing with things. So the final question to leave you with is this. You've neutralized the biggest threat. What happens when you learn to control those other invisible forces too?